Afternoon, everyone. It's a pleasure to be here. Thank you to the UK-GCC team for inviting me to moderate this panel. One topic that's come up again and again through this morning's panels and is a crucial component in private markets is the liquidity issue and how complex it is. We heard from real estate practitioners earlier and the slowing of deal flow, exits in the private equity space. Realizing value and recycling capital is crucial to the private capital ecosystem. Unfortunately, we have three key practitioners in the space to pick the situation apart with us. So, by way of introduction, I'm Alasdair, Chief Investment Officer of Sanarus Investment Management, and we're a boutique credit manager here in London. And I will hand over to the panelists to introduce themselves.
Sure, thank you, Alasdair. I'm Tony Catachanas. I'm the CEO and founder of Tower Peak Partners. We're a global private equity operation. We're independently owned. We have a presence in the United States, headquartered here in London, and are present in Brazil, in Rio and Sao Paulo. We invest in private equity of an industrial kind, predominantly. Think chemicals, energy, transportation networks, materials production. We invest in aerospace and defense in Europe and in North America. And we deploy capital as well in the media, entertainment, and sports sectors as well.
Hi, this is Rocio. I'm a partner at Altamar CAM. Altamar CAM is a European asset manager. We manage or advise like 20 billion of assets. Bulk of it is private equity, but we also invest in infrastructure, venture capital, real estate, and private debt. We invest mainly in Europe and the US, but we also deploy capital elsewhere. I personally cover North America. I invest in funds, so I do primaries, but also secondaries and co-investments. So I'm looking forward to the discussion today.
Hi everyone, I'm Hani Khoury. I'm a partner at Coller Capital. Coller is a leader in secondaries across private markets. 54 billion of assets under management. Everything we do is in secondaries, but we are the heart of the ecosystem in private markets, whether it's private equity, private credit, growth and venture, and expanding those asset classes. I sit in London in the investment team here in London.
Okay, amazing. We've got a pretty diverse audience, so maybe it's worth setting the scene with what the current state of liquidity markets are in private equity. So it'd be good to hear what the issues are, what some of the conflicts are when it comes to traditional exits. Maybe Anthony, if you want to kick us off.
Okay, so I've got the early view. I think for some time we need to let's think about it in terms of a timeline of evolution of how the industry has evolved. So if you go back to the buyout industry, you have an activity that essentially spins out of banking that makes use of leverage to acquire positions in companies. And there was an economic backdrop tailwind that led to increasing valuations and acquisitions in companies, delisting companies predominantly throughout the 80s, early 90s, and into the early 2000s. And the buyout industry to this day is still the largest component part or segment in the private market industry globally. Infrastructure is growing significantly, is catching up, but is still relatively small within the overall broader private market landscape. When you think of liquidity, if you think about the component parts of deploying capital into the sector, into a range of economic sectors in the global industry, or the global economy rather, you end up in a scenario where there's a use of leverage that increases sensitivity to interest rate cycles. And we've seen over the last 30 to 40 years, interest rate cycles become more and more frequent in the global economy. And that has caused a number of difficulties and hurdles for managers to be able to exit positions. We've been traditionally looking to IPO markets back in the 80s to exit positions. So we would delist, hold a company for a period of time, try to list through public markets by way of a listing. That pool of capital eventually waned and disappeared. We started building the secondaries industry where we were manufacturing our own pools of capital with other GPs. And groups like Coller were some of the first in the industry to build up, obviously, that presence and contribute to that particular pool of capital. But if I'm not mistaken, and Hani will put me right, that pool of capital still only represents around 20 to 30% of exit capital available for GPs. And so today, we're hearing conversations around continuation vehicles. We're talking again about structural mitigants or structures that allow us to manufacture liquidity for GPs to be able to find exits. And so we're still working on building structural resolutions to a more fundamental problem. And you have to pair that as well with the backdrop of the fact that we have, because of the interest rate cycle again, and the availability of cheap credit, been also, had the prerogative of utilizing more credit in our transactions, certainly of late, because of low interest rates, and have at the same time been riding the market cycle to drive valuations. That hasn't helped us. And unsurprisingly, LPs are holding us accountable. So how have I done on laying that out?
So maybe to step back, if I want to be negative, I would say that the PE market is in trouble. If I want to be constructive, I would say it's in a transition period. So let's just say it's in a transition period. So and the reason I say that is whichever way you look at it, we are moving from one model to another model. And the earlier model up until 2022 was a model of overcommitment by the industry in general, a fast deployment pace, multiple expansion, cheap capital, and the notion of whatever I buy, I will have an exit for in 3 years' time. That was kind of the equation. But that has changed fundamentally for all the reasons we know. And I think the model today is shifting much more towards the ability to create liquidity in your portfolio in a thoughtful manner, the ability to have value creation plans on a longer horizon, and the ability to pick the right spots in private equity. So I think the job is harder today. Not everyone will do well, and as much as the previous model was about scaling deployment, this model now is about value creation and scaling liquidity. That's what we need to do. When you look at the overall market, distributions are moving up a little bit, but as a percentage of NAV, we're still at historical lows. We're anywhere between 10 to 15% of this in buyout of distribution a year. I think the market needs to be closer to 25, 30% to function properly. On that point, I think we're kind of in that transition of figuring out the liquidity tools available. I mean, in buyout, you have 32,000 companies that are 5 years or older. At the exit level, the whole peers are moving to 6 years, 7 years. That's a new structure that we need to get comfortable with. Sorry.
No, what I would say is that, that's a new reality. I don't know if, like private equity investors want to get used to, holding companies for 6, 7+ years. So there is a dynamic there where, obviously as private equity investors, and I am a private equity investor, and I invest in, in funds, in primaries, we are seeing, GPs holding assets for longer and longer, but with not a clear path of exit. And even though as an LP, we don't have much to say or we don't have much to do, obviously for those, we need to put pressure into the GP to find a solution, for that exits. Because in the end, when, like the majority, I'm not gonna say 100% of, private equity investors, but the majority of private equity investors, they want in and out at some point. And it's true that, prior to 2022, I agree that, some holding periods were 3 years, then it became 5. That was more or less the average, like the historical average, but now it's 6, 7 plus. So, so there is a trend where, where I think GPs are holding assets for longer and longer, but, they need to find a solution, and there has to be like a structural change, so that we find a way of, exiting those companies. And obviously, I mean, we are very active in secondaries, and obviously secondaries is one of them.
And I'm going to say something that is very self-serving, but I think there needs to be more capital going into the secondary market, because the opportunity is very good, but also because secondary as a tool has moved from being, let's say, a maintenance solution in private market to becoming in the engine room. I mean, today, it's difficult to imagine private markets operating efficiently without a healthy secondary market, both for the LP, for the GP, for price discovery. You need a very healthy secondary market to allow the flywheel to continue to operate properly.
Okay, there are a couple items, variables, I think, that drive as well the manufacturing of an exit. We're in the business of manufacturing investment strategies that deliver an exit further down the line, return capital to our investors, and we're now being held to account for that more so today than ever before. And I think it was Henry Kravis that said, any fool can buy a company, but very few can sell one. And that adage is still true. That is absolutely true. The deal-making ability of a GP is sacrosanct to being able to efficiently exit a position. And I think there are a lot of GPs in the world today, very, very hard to believe that there is that much deal-making ability. And so that is inevitably going to be a function of this. Another function of this is inevitably also what sectors are we choosing to concentrate capital flows in. And we've been choosing highly cyclical sectors that are more sensitive and benefit from multiple expansion, a market-driven multiple that you're just riding a wave of an economic backdrop that is self-serving, and where natural affinity and sensitivity to interest rate cycles help you in that context. And so you go for more cyclical industries. You end up in, not that we would shoot down any of these industries, they're essential to the global economy, but more cyclical industries like healthcare, consumer products, or software, now a bad word. And so we have to move away from the notion that we're going to be making money and creating value for investors in a way where it's an easy walk in a park and it's a free lunch. And we now need to revert back to the reality of any fool can buy a company, very few can sell one. And so we tend to look at industries that are more cyclically resilient, where there is a need to go into the company and drive operational optimization, operational efficiency, and really roll your sleeves up and go into the company. And that's becoming a topic that everyone on previous panels, on this panel no doubt will recognize, because driving fundamental value is a precursor to doing a good deal further down the line and exiting a company. The exit of a company is always contingent on what are the arguments for the buyer? Why would that buyer want to buy the company? whoever that buyer is. And then identifying the constituency of that buyer drives how efficient, or knowing the constituency of the buyer and their motivations, drives how efficiently you can deal make on exit. And that, I think, has been lost because we've been caught up in just riding the market. And that has to stop.
No, what I would add there is that obviously valuation has also, something that needs to be paid attention to, right? Like nowadays, people are not exiting companies because they are not getting what they think they deserve for that asset. So if the market is speaking, what I would say is that, regardless if it's the secondary market, if it's, the more traditional M&A market, whatever market you are talking about, you need to be realistic with the marks and, your valuation is so that, you are fair to yourself, I would say, but also fair to your LPs, right? Because you are holding marks that do not make sense in this, in this environment. There is a lot of uncertainty, obviously. And that's also that for me is key when thinking about, not only value creation within the company, that obviously that's a given for positioning that company for an exit, but also being realistic on how much you can make and how much your company is valued.
Maybe just to follow up a little bit on those points, which I strongly agree with. The exit, in a way, is the gate to value creation. Because you can do as much value creation as you want. If no one wants to buy the company, what's the value in that value creation? Not much. And so on the value creation process, I think for the good GPs, has expanded to include the exit strategy from day one, in a way. And for many companies, I think GPs in their portfolio, if they have in a fund 15 assets, within 2 years of ownership or even before, they have a sense of where this is going, both in terms of performance, but in terms of exit routes. But I think, because today I think you have a new dynamic which you will have companies that are ideal for an IPO. You will have companies that are ideal for a trade buyer, and you have companies that are ideal for a sponsor, and you have companies that are ideal for a continuation vehicle. And so the profile of the company will determine the exit route, and the thinking around that has to happen very early on at the company level, but also at the fund level, in the sense that today, I would think it's impossible to have a well-performing fund that is not thoughtful about overall portfolio exits. And especially if after 2 years you think you're not going to deliver, your objectives, why hold on to it so long? So you have to be much more strategic in the way you create that DPI in the life of the fund versus holding for no reason. So I think that dynamic is shifting, and that skill set is building with fund managers.
And I would add, I agree with everything that you just said, and I would add that GPs also have to be realistic when a company is IPO candidate, and the exit route that you were mentioning is just an IPO. When you take a company public, you can't sell everything they want. So you will need to be, thoughtful on, I don't know how much it will take, 3 years, 4 years, you have your lockout period, usually 6 to 9 months. So, so I think GPs have to be more, and they are, they are working on it, but, they need to be more realistic on, the exit route since day one, and be realistic also on how they are going to achieve that, because it will require time, obviously.
Look, I think having gone through an IPO myself, having IPO'd a company, the IPO process is something you plan a couple years in advance, to your point. Has a range of different component parts to structuring an IPO deal. So when you go into that, you you have a PR and communication strategy. You have a strategy of rationalizing your balance sheet, rationalizing your operations, speaking to a cohort of money that dominates what public markets participants would call real money players who will underpin your IPO. You don't underpin an IPO with retail money, you underpin an IPO with pension money and insurance money. And in the public market world, they're referred to as real money for good reason. And so, when you go down an IPO path, you have to have the preconditions and component parts and ingredients to be able to go into an IPO situation that speaks to that cohort. And very often, we omit the sensitivity of the reality of those cohorts that will be coming to the table. And it's often because there's actually a whole generation of us in the industry that have forgotten how to do IPOs, because that was the previous generation. That was the Henry Kravises of the world and so on, who are very good at that. And so there are situations that are IPO prone, no doubt, and there are some happening. But there are fewer listed companies today, half of what there used to be. And venues are becoming less and less attractive as well. Going through an IPO exit is a process in itself. And we are, after all, in the business of manufacturing value within the context of a company. There's a concept called active alpha, which is intrinsic to private equity, of sitting on, through ownership on the boards of a company and working with a management team to create value and get a company into a position that is conducive to a sale. But that should always be the prerogative of an investment in private equity in a private company, or any company for that matter. We should always be motivated to invest in a company for that reason. And so I don't know if this is necessarily a value play where the decision-making on the valuation at entry matters more than the active alpha component that leads eventually to manufacturing the exit in the correct way. We've been focusing a lot on the valuation element, which is data-driven, information-driven, signal-driven, and we try to find an optimal way to price and value a company at point of entry, which is important. I don't want to play it down, but we spent a lot of time thinking about that at the expense, perhaps, of thinking about the game plan to create value within the company, and instead anchor the value creation part to a component that is driven by the market. And so more cyclical industries inevitably are going to lead the show, but they're also more sensitive to business cycles. And so when the business cycle turns, you're left stranded. Anchor yourself perhaps in the choice of industry that you go into, the choice of company you go into, that has a much more resilient balance sheet, prone operation, assets on the balance sheet, less cyclical, can command bank capital, can command an efficient cost of capital, can create much more resiliency through cycles, and you get into a position where your exit conversation is being manufactured from the very start in the choice of the sector you're investing in, how you channel capital into parts of the economy. Of course, the valuation is important, but it's more important, I think, to drive value within the company and then to manufacture a couple of years in advance already, prepare that exit. And it takes a while, and it's a marketing strategy, a backdrop, PR comms, driving value within the company and so on.
I think it's maybe worth exploring, because it sounds like if you're to look at a high level, that you have a deal, you can't explore an IPO, you can't exit through a traditional avenue, so you're going to look at secondaries. But it seems a bit more complicated than that. Then the opportunity set in secondaries seems a lot wider, right, than just difficult companies that aren't available for IPO. It'd be interesting to understand from both Rocio and Hani what the kind of supply dynamics are. What kind of deals are coming through secondaries? Are they distressed deals, either an IPO or stuck in certain sectors like software as a service, which are difficult to offload? It'd be interesting to understand what those dynamics are, and maybe, what is the opportunity set in secondaries and why investors should look at that.
What I would say is that the secondary market has changed. I mean, I've been doing secondaries for 20 years now, and the secondary market has changed dramatically. So if I think what we were doing in 2008, 2009, obviously that was very opportunistic, and anyone that brought anything to the market, to the secondary market, will be troubled somehow. regardless of speaking about an LP that needed to sell or a GP that, brought kind of a GP-led to the market. And, secondaries was equal to trouble. I think obviously everyone knows that that has changed dramatically. And, we are talking about, continuation vehicles, as you mentioned, that you can see, since day one, if, that company, it's going to be like a star asset and, and you would like to hold it for longer, then LPs are using, the secondaries market as a, as a portfolio management tool. I mean, all of us here included, right? So I would say, the secondary market right now is, is well known and people embrace it as a, as a solution to give liquidity to a market that it's obviously illiquid. So I would say, that stigma of secondaries being equal to trouble is gone and over in my view now. You will find a lot of things, right? Like you will find those LPs that need to sell because they need to sell, but there's no. I mean, no one is ashamed of using the secondary market anymore, and it's very efficient. Regarding the companies or the assets that go to a CV or a GP led and so on and so forth, I mean, you will find a different, like a roster of things that you will find in the market. And I think all of us, the market is so broad and it has grown so much that all of us can find their space or their spot where they can be successful. But I would say that that notion of, a GP bringing something to market because its trouble is gone. And on the contrary now, a lot of GPs, and you need to understand why, like the rationale behind, bringing that asset to market, to the secondary market, but most of them are star assets, I would say, nowadays.
100% agree. And I think more and more this point has become easier to answer in a way, because very big picture, it's good to be reminded by a few things. One, the supply-demand imbalance in the secondary market. You have anywhere between a year or a year and a half, generally over the last few years, of unfunded capital in secondary market compared to transaction volumes. So there isn't capital for everyone. So the filtering is very high in our market purely because of that dynamic. The second element that you can look at is around performance. When you look at the average performance on a TVPI basis, so the current performance of the assets that are coming to the GP-led market, it is high. Now you can say, okay, but who believes those valuations? But on average, those are the higher performing assets sitting in private equity that are coming into the market. And then when you start to look at what is being achieved in terms of exits from CVs, you can see very strong performance, very high compared to buyout, but also a spread that is narrow in terms of things that are going wrong versus things that are going well. That spread is very narrow compared to buyout. And look, I think fundamentally that market is really about GPs wanting to create liquidity, but also wanting to keep those assets with them. One of the hardest things today for a GP is to find good assets. And so when you're sitting on a good asset, they've held for 5 years, they know exactly what to do with it for the next 5 years, why give that carry generation to your competitor, kind of, right? Why not keep it with you? Create that liquidity for your LPs, but keep it under your management, which I think is a very elegant solution to the opportunity of holding assets longer. You know, today, a few years ago, some funds were saying, oh, we want to raise 15 years, 20 years fund to hold assets longer. But okay, you're going into those assets, you don't know them. And you're already saying you want to hold them for 10 years. It didn't really pick up with LPs, back to your point, because LPs want in out. Whereas the CV market provides the solution for the GP saying, you can own this asset for 10 years or 15 years if you do a CV square. But we're going to create those windows of liquidity to allow people to come in and out, and those that want to stay can benefit from the future growth. Sorry.
What I would add here is that I agree 100%, but we need to be honest with ourselves in the sense that, you know, obviously the CV market is a great tool, but not every single CV makes sense. So, you know, so we need to, you know, we need to make sure that, you know, those CVs make sense, that there is a reason why the GP wants to hold it for longer, there is a business plan that can be put in place and so on and so forth. Because I would say, you know, I don't know exactly what the percentage was in 2025, but a lot of CVs that come to the market do not close. And there is a reason for that, because not everything makes sense. So even though I fully agree with, you know, with the CV market, and obviously I participate in the CV market, and I think it's fascinating, we also have to be honest with ourselves and say, you know, what makes sense to bring to market as a CV, and that's important.
Okay, well, it's a very big topic, and I'm sure the audience is hungry for more, but I think everyone's also hungry for lunch, and so I think we'll have to end it there. So thank you very much to the panel, and thank you.
Thank you.
Thank you.